there was some talk and there were a lot of reporting, etc., which said that you were involved in the recent big Vedanta block deal as well. Were you guys involved in the deal?
No, we were not involved in the deal at all. So I think it's kind of amusing to see almost every deal our name comes up. So there's no point denying every deal because there's a deal every week. So no, we were not involved at all. We didn't buy a single share.
I see. Well, were you sort of talking to them at least, or there was nothing at all? I mean, you were not.
Well, look, I mean that's our job. We meet a lot of managements,
okay.
And we look for names where there's a little bit of sort of perception gap and the structural assets are good. So we talk to a lot of people all the time, but that was kind of very specific announcement. But there have been cases in almost every QIP, our names get dragged in for some reason. So we can't keep denying everything. So
to press that point just a minute longer, have you taken a look at Vedanta? Any thoughts? I mean, that would fit that criteria, right? Gap in perception, good assets.
Look, I think we have looked at them, but at this point it'll be sort of inappropriate to specifically comment about names where we don't have existing position as such.
Got it. Now PSUs are the other space, Rajiv, which have done phenomenally well, right? That's another area where there has been a sea change as far as perception is concerned. You own large names like SBI and NTPC. Have you looked at others in any areas where you think, which you think will do very well? I know for a fact that you think there's this, oil and energy markets are in for a structural bull market. A lot of exposure in the PSU space there in that area, and stocks have done well. Your thoughts, Rajiv?
So we looked at the oil names, and if they were more liquid, larger liquid, probably would have bought them because for the last 2.5, 3 years, we've been very positive on a lot of PSUs. I mean, include State Bank of India, NTPC, Power Grid, and we own in some small and large way. I think some of these are basically look at our size and scale. We can't execute because sometimes blocks are not available. By the way, LIC is the same one. We would have loved to buy that. We couldn't find any blocks last year, early last year. So I think some of these are just hard to execute from our vantage point because we like to run very constant book. But I think one thing which is, and these were not simply cheap. What we saw was just much more tighter management. I mean, if you look at NTPC, we quite like how the current management has done a much better job versus historically. So there's this sense of urgency you're seeing in a bunch of these, and I think they're also getting a lot less intervention from Delhi, which was a chronic problem historically, right? So in last 10 years, the intervention has gone down dramatically. In fact, they pushed to hire some very competent people, a lot of these companies. So I think long term we like these, but obviously today a lot of them are done well. We still like them, but our problem sometimes is that we like to run constant portfolio and just hard to execute because those are blocks that are hard to find. But otherwise, I think, and as you know, these things are very under-owned by vast majority of foreign investors too, because there's this perception there that state-owned companies are always bad. Nothing is always bad, and nothing is always good for that matter.
So we are talking about when you say what you like, we basically talk about PSU oil companies, right? Upstream, downstream, standalone refiners, right?
We don't own any of those. We don't own because look, I think first of all, we have only X amount of dollars we can invest in India. Yeah. We almost have a third of emerging market fund in India, right? So I'm not running an India book.
Yeah.
So there were too much choices.
Yeah. No.
So we don't own any oil companies, but we do own some of the oil companies outside.
Got it. But you like that space in India, right? That's the thing. You don't own it.
Yeah, we generally like that space.
Got it. Fair enough. Let's just talk about private sector banks for a quick bit, Rajiv. You used to own HDFC Bank. You don't anymore. You still own ICICI Bank, I think IDFC First Bank, SBI I mentioned earlier. Just a view on HDFC Bank, because that's been such a sort of, long-term compounder, which for the last couple of years has basically gone nowhere. And a lot of questions around that. Any thoughts?
Look, I think these both HDFC and HDFC Bank were some of our core holdings for a long, long time. I mean, I first bought HDFC, I believe, in 1998 and held it through thick and thin. And HDFC, first time I bought in 2001, late 2000, early 2002. And I always joke around that if you look at these two names, that made me look a lot smarter because we bought them and we didn't have to do anything and they kept compounding, right? I like management where we kind of take a backseat and they do the job. And these were some of those. So However, we just thought there were better opportunities last year, so we did exit HDFC Bank, and I think some of this is simply transition issue that we are facing in terms of that was a big merger more than any structural problems. We don't see any structural issues. It's more a transition issues in terms of the two big entities have merged. But on our case, we just had sort of as I said, we have limited amount of dollars what we can invest. So we look for the best bang for the buck, and we thought the SBI has far bigger disconnect than HDFC, which is a very, very high quality franchise, and it's very likely we'll own it somewhere down the line again.
No, that's well put. But for PSU banks, which is the other space which has done well, do you think there is a lot more room in terms of re-rating? I mean, valuations have come up to 1.5 times book for most names.
Yeah, look, I don't believe there's more re-rating potential. I mean, unless the whole market re-rates. Now it's an earnings growth. We'll have to do the job.
Okay, that's the view for PSU banks, and for HDFC Bank, you're saying that you perhaps will own it at some point down the line. Now, Rajiv, let's talk about consumption, right? Because for a fund as large as yours, and you've got over $20 billion invested here in India, a lot of straightforward consumption bets, and India was always seen as a big consumption story. A lot of straightforward consumption bets are missing. You have those, but not the typical large ones. Why is that?
I think, as you know, markets are nothing but arbitraging machines. So they will arbitrage what is obvious. So you really have to look at some level of disconnect to get sort of outsized returns. And a lot of consumption names we thought got re-rated quite dramatically. So if you go to the post-GFC, you could, and we bought a whole bunch of them from Nestle to Hindustan Unilever and so on and so forth. They were reasonably valued for the growth that they were delivering at that point. A lot of those names, which are still fantastic franchises, but the disconnect isn't there. Not to mention the relative earnings growth is far better in some of the other areas. So we do own ITC and Patanjali, as you know, but besides that, we haven't really owned that much for the reasons that I just cited. So I think the consumption story is still alive and well. The relative earnings growth will be lower than some of the other infra areas. And that could, by the way, 5-7 year story. It's not a 2-year story in terms of relative earnings growth between those. Second, I do believe that the competitive intensity has gone up. If you look at the volume growth that you see in some of the larger players, it's been on a softer side versus their own history. Could that be short-term cyclical? Maybe, but I think there's something to watch.
Got it. What about IT services? I mean, I know that you have globally, I think NVIDIA is one of the largest positions for you. You own other large sort of tech names as well. What about IT services here in India, Rajiv?
Yeah, IT services, we have been a little more cautious for almost 18 months now. And we feel that the valuations are not incorporating what we feel would be a slightly slower growth profile on a go-forward basis. So the markets are far more comfortable with the growth, the rate of growth that these companies can possibly deliver. And second thing is we find from a tech perspective, just better opportunities elsewhere. For the same, if not better growth, you can find it cheaper outside. So, we feel that there's much more bang for buck in other names in India than IT services.
Rajiv, as an investor, as you said, you like things where there is a big sort of disparity between the reality and the perception of it. Do you think China fits the bill, or their bad is just bad? Are you looking at it as a interesting investment opportunity?
China is confusing because the stock prices have come off quite a bit. However, the lot of policy issues, the political aspects have not gone away. So we have not increased our China exposure. We are extremely underweight China. In fact, we only have 4 or 5% China. I mean, that should give you some context. That's in EM. We have no exposure in the global or the international book as such in China. And 4 or 5 years ago, we used to have a lot. But we do feel that there's a geopolitical aspect which is playing an important role in terms of how people will perceive China. So, for example, if Trump wins, I think there's a high chance of escalation geopolitically between U.S. and China, and that could impact foreign investment into China and or their reluctance to invest further. So I think there are things on the horizon which kind of give us a little bit of pause. And Trump has already announced some of these things that if he wins, he's going to increase tariffs and so on and so forth. So I think the saber rattling will increase, which is which is a little bit of a problem.
Rajiv, in terms of China, there's this entire China plus one, not just in terms of FDI, etc., but in terms of financial flows, portfolio flows. And many have said that, India will be this big beneficiary of foreign flows away from China. Is that already underway or is that yet to happen? Your view?
There hasn't really been much inflows at all. If you look at cumulative inflows in the last 2.5, 3 years, they've been one of the biggest outflows from India. So I don't feel that has happened yet. But if the geopolitical situation continues to move in the direction where I believe it's moving, it's just getting worse. I think the flows have yet to come to India. We have not seen that yet. If you look at vast majority of global portfolios, the India exposure is tiny. And it's typically limited to maybe one private sector bank, one IT services, and that's about it, right? And all that will change because the earnings growth, if it comes through, and it has been coming through, as I said, India is the best earnings growth story outside of US in the last 5 years. It's not my opinion, it's a fact. If you look at MSCI India versus all the MSCIs and compare that to other markets. So I think the flows story has not been positive for India. In my opinion, it will become positive as time passes.
Got it. Rajiv, we'll leave it there. It's a pleasure having you with us here on CNBC TV 18. We look forward to many of these over the next, a few months. Appreciate your time here, as always. Thanks very much.
Thanks for having me. It's good to talk to you.